Welcome to the BTRM hybrid seminar on the PRA's strong and simple framework. Many of you may have attended the session that we ran last week. We've had to re-record a small part at the beginning because the recording didn't work. So hence you'll notice the cutover some way through this. The PRA's proposals are known as CP4 23, and it's about liquidity and disclosure requirements for simpler regime firms. We'll come on to what that means in a moment. Moving on to the next slide, you'll see the agenda. We've got quite a simple, straightforward agenda. I'm going to talk for a while on the development of a simpler regime for small firms. So I'll be talking at quite a high level. Then we'll run through all of the PRA's proposals, and then towards the end of the session there'll be questions and discussion. However, if you make it all the way through this video, what you'll find out is most of the questions and discussion happened during the presentation. Moving on to the next slide, you'll see the guy on the right hand side carrying the block of concrete, and that illustrates the situation that many small banks find themselves in at this moment in time. In particular, the regulatory reporting teams within those small banks. At the moment there's an absolutely huge amount of rules, regulations that these guys have got to understand and apply to their organisations, and then in many cases report, but in many other cases not report because it's not necessary. However, it's important for the guys to work through all the rules and regulations to find which ones they have to report and which ones they don't have to report. So what we're talking about today is in some senses long overdue, but it's how the situation can be made simpler for smaller firms. And the proposals that we're running through are consistent with the government's aim to deliver smart regulatory reform. So moving on to the next slide, what is the simpler regime for small firms? Well, there's some qualification criteria, and the ones I'm going to run through now are slightly different to those that we discussed last week. If you were present, you will remember that we had to clarify a point. We have now clarified it, and there's a very small change to the slides. So CP 1622 set out the proposed criteria that small firms needed to meet in order to qualify for the simpler regime. It starts with the size of their balance sheets. In total asset terms, the balance sheet needs to be less than 20 billion. But there are some other requirements to meet as well. The assets need to be located domestically. The business needs to have a very small scale trading and foreign exchange part, and you'll see there's some figures right at the bottom of the slide that demonstrate how small that has to be. So the trading book business needs to have assets of less than £44 million, and that 44 million be less than 5% of the firm's total assets. And foreign exchange positions must not exceed 3.5% of the business's own funds, or 2% of its own funds on average. Moving on to the next category, there should be no commodities or commodity derivatives. When it comes to calculating capital adequacy, the firm needs to be on the standardised approach. So that's the bottom left-hand box, no IRB or foundation approach acceptable. There should be no clearing, settlement or custody credit risk, no payment operation, and there's a final requirement, which is satisfaction of parent consolidation requirement. So if the small firm meets all of those, then it may qualify for the simpler regime. And just to clear up the issue that we faced last week, there has been a subsequent CP, CP5 23, which discussed the disclosure requirements relating to remuneration, and there are within those disclosure requirements definition again of small firms, and it's a slightly different definition of small firms, because for the purposes of remuneration disclosures, any firm with total assets of less than 4 billion would automatically qualify for the simpler treatment. So when it comes to remuneration, there's kind of an extra category. Less than 4 billion, you automatically qualify, or between 4 billion and 20 billion, and then you would need to meet all of the other items that I've just gone through. So hopefully that clears up the situation. For the purposes of the simpler regime for liquidity disclosures, then it's what I've just gone through. Moving on to the next slide. So the objectives of what we're talking about: simplify the prudential framework. And if you do that successfully, it's going to reduce the costs of understanding, interpreting and operationalising the requirements. If you're not spending as much time on that, it's going to reduce the barriers to your growth. But the trick here is to do this in such a way that you maintain the resilience of your firm, or all of the smaller firms. This simpler regime is going to be split into two phases. Phase one, which is the one we're going to talk about today, is non-capital related prudential measures. And that was published in February of this year. And although we'll come to it in a minute, the PRA has asked a number of questions that it invites banks to reply to, and they have to do those replies by the 30th of May. So as we go through, if there's anything you think your organisation could usefully comment on, then 30th of May is your cut-off. But as far as I'm aware, you can only respond to the 5 questions that we'll see at the end. So they're not asking everything. And then next year, in 2024, there's going to be a phase 2. And phase 2 is going to be about capital, when phase 1, the one that we're talking about today, is non-capital related measures, a lot of which relate to liquidity. The logic behind splitting this into 2 phases is probably to make it more easily consumable by everybody. So bank some of the benefits quickly, then move on to the next stage, as opposed to trying to do the whole lot in one go and getting caught up in lots of red tape. The phase 1 proposals are split broadly into 5 categories. The reason why I've got all these numbers is I'm going to go through each of these categories one by one in a minute. So firstly, new liquidity requirements for the application of the net stable funding ratio. Then some revisions to the application of Pillar 2 add-ons. A new template for the ILAAP for firms that meet those qualification requirements. The removal of certain liquidity reporting templates, and some new Pillar 3 disclosure requirements. And finally, the simplification of certain proportionality approaches. So, getting stuck into the first one of these, the net stable funding ratio. So, that was first proposed, I think, in 2010. So, it obviously wasn't an easy implementation. That the first time it was actually formally introduced by the regulator was January 2022. The net stable funding ratio, as I'm sure most of you know, but a few may not, so I'll just go through this. It's the available amount of stable funding, so that's basically long-term funding available to fund long-term assets, which is your required amount of stable funding, and under the net stable funding ratio, you needed an answer of above 100% at all times. At the moment, firms that qualify as small and non-complex institutions can apply for a simplified version of the NSFR. So you can either do the main one or a simplified version at the moment.
One question.
Yeah.
Why they excluded LCR? When you go to get LCR and NSFR?
Any views? So the question. Sorry. So thank you. The question was, if we introduced a simplified version of the NSFR, why didn't we introduce, or the regulatory authorities introduce, a simplified version of the LCR at the same time?
Well, NSFR is long-term funding. LCR is short-term funding. So why would you introduce short-term funding? It's runs on the bank. You wouldn't have short-term funding available.
Okay, well, so that was about NSFR focusing on the long term, which absolutely it does, and LCR focusing on the short term. However, I'm not sure the question is about whether it would be possible to simplify the LCR ratio rather than kind of do away with it. Okay, anyway, Akash, was it? Aramesh, sorry. We haven't got a straight answer for you, but the fact is that at the moment, under the rules, there's an NSFR, and certain institutions, smaller and non-complex institutions, can benefit from a simplified version of the NSFR, which was all that was on offer. But in practice, the small and non-complex institutions haven't actually taken this up. Okay, so it's there, but no one's, or not many, are reporting that way. The only reason, you probably can't see this on the screen, but you don't need to. It just runs through the various factors that are applied for available stable funding, and the conclusion is that retail and SME deposits are basically the best form of deposit for the purposes of calculating NSFR. So if you have a lot of retail and SME deposits, that is a really good thing. You'll see why that's relevant in a moment. So this is proposal number 1 from the PRA, and it is to introduce a new calculation, something called an RDR, or Retail Deposit Ratio. That ratio is simply the total amount of retail deposits for an organisation divided by its total funding. So fairly straightforward to calculate. The idea is that if an organisation meets the RDR condition, which I'll come to in a moment, then the NSFR would no longer apply. If, however, it doesn't meet the RDR condition, then the NSFR would apply, but only the NSFR, because what's being done away with is that simplified version of calculating the NSFR. So at the moment we have SNSFR and NSFR. What we're going to have in the future is RDR and NSFR. Okay? Going back to that condition, to be able to use the RDR, the 4-quarter moving average of your RDR calculation must be greater than or equal to 50%. So your retail deposits, which comprise your kind of natural persons, people and SME deposits, must make up 50% or more of your total funding. Now, if you're very close to this cutoff, such that maybe you're above 50% and then you suddenly dip below 50%, then you have a year to re-implement NSFR. If you're a new firm and you've just come into existence, then there are some transitional, or proposed to be some transitional arrangements. So the logic here, we saw from that NSFR slide how valuable and important retail and SME deposits are. The PRA has come to the view that when a firm has a RDR of above 50%, it is predominantly retail, which seems logical. And that by doing away with certain regulatory reports, listed here as C80, C81 and C84, which are the ones that relate to the net stable funding ratio, which you would no longer need to report on if the net stable funding ratio did not apply to you, that would save 758 data points. So are you guys involved in the reporting function?
Yeah.
So is 758 data points saving good news?
But I think I work for risk management, so I review the regulatory return as well. But from a treasury point of view, it will be very difficult because I'm working in Middle East bank, so it's not a domestic bank. So that bank is more funding comes from corporates. So my 50 to 60% balance sheet, the funding comes from the corporates, and the retail deposits are, because we are Middle Eastern bank, the retail deposit, say there is something called like a raising platform, aggregated deposits. That deposit is like 4% in the market one, so it will be very expensive. And to achieve the 50% of the ratio, I don't think it will be difficult for a small firm.
Okay, so sorry, a quick answer for those who are online. Our colleagues in the room who are affected by these regulatory changes actually have a lot of corporate deposits on their balance sheet anyway, so it's not certain exactly how it will affect you.
Those data points are in the balance sheet, so no one's getting rid of their balance sheet. All it is a mapping in a reporting software. So I'm not convinced any data points.
Okay, good, great, I love that. So another comment coming in that's saying, hold on a minute, all these 758 data points that the PRA has referred to and you're referring to, Chris, are actually in the balance sheet anyway, so are we getting rid of anything? Fair point. However, we must be making a saving in terms of not actually needing to produce C80, C81 and C84, 3 regulatory returns, and get them signed off and submitted. So there is going to be some saving, presumably. Also, from the PRA's perspective, the cost of calculating that RDR, retail funding divided by total funding, is perceived to be negligible because it comes from items that are, sir, already in the balance sheet.
All you're doing is swapping the mapping from NSFR to RDR.
Yes. Okay. So the comment, all that we're actually doing here is swapping some mapping. Thank you for that. So my actual angle when I looked through this was something slightly different, insofar as if the general approach is that banks with a high proportion of retail deposits are not very risky from a liquidity perspective. So therefore, why are we putting a restriction of 20 billion on? If you're predominantly retail, say, I don't know, 75% retail deposits, then why can't we make that balance sheet size number much, much bigger? Why does it have to be 20 billion?
Because that's what the EU did.
Does it come from the EU? Okay, so although we're completely separate from the European Union, we still follow many of the rules and regulations applying there, appears to be the conclusion. Any other thoughts? Yep.
They also introduced a simplification of the LMF before the PRA did. So,
okay.
Yeah.
Right, so we'll come to that in a moment. But it has been suggested that the EU introduced some other aspects that we're going to talk about before the PRA as well. So I just leave that point there.
There's a comment online also. If firms are allowed to opportunistically flex their funding mix, they could want to still have an NSFR so that they are able to offer non-retail levels of funding.
Yeah, I'm just factoring it in. Yep. Oh yeah, sorry. Okay, yeah. So I did see something that flashed up briefly, talking about building societies that were predominantly retail funded, and the comment that what I've just suggested would be a good idea for the nationwide building society. Well, I'm talking seriously. Why is size such a thing here? Surely it's risk that matters more than size. Is what I'm throwing out there in my question. Anyway.
Can I comment?
Yes, please do.
I mean, the strong and simple was conceived as a layered regime, and what you're talking about here is a simpler regime, which is layer one, first layer. So we haven't ruled out that there would be simplifications for larger firms.
Okay,
but they've got to be in a subsequent layer, which we haven't got to yet.
Okay, perfect. Thank you. That's really good. I'll repeat that on here, then I'll come to you, sir. So the comment being, from a PRA perspective, we're talking layer one at the moment, which is concentrating on the smallest firms, and potentially in the future, we may see a subsequent CP that focuses on bigger firms and may make some simplification for them too, if they're perceived to be not risky. Yes, sir.
Just to answer the size question you mentioned, 20 billion is not systemic, so it can be resolved easily directly. That's all wrong. That's why there's probably different rules for different categories of depending on how large the organisation.
No, good point. So a question on size, linking this to the systemic nature of the organisation, and obviously if size is small, then it's much less likely to be systemic. Okay.
One observation. It does seem to be surprising that a firm can be up to 50% wholesale funded. Now, we're absolute about quite low absolute numbers, but high relative numbers for the firm to be up to 50% wholesale funded. No information, as I understand it, on term structure, that wholesale funding, or on operations or whatever feeds into any liquidity metric.
Okay, so a challenge the other way, concentrating on the 50% wholesale aspect. So if your RDR is according to my interpretation of the rules, so I accept so we have an outstanding issue on this, but according to my interpretation, you could have an RDR of 50.5% and a balance sheet of 3.99 billion, meaning you've got 49% wholesale funding and no information on your exposures going to the regulatory authorities.
Certainly not in the form of a metric.
Right. I mean, normally in the way this is written, there is a kind of undercurrent cleverly inserted by the PRA, which basically says in those situations they can come and ask what they like and one-offs, etc. So I imagine this is the broad brush, and the individual level will be discussed between the local supervisor and the PRA. And I'm getting nods, which is a good thing. Okay, I'm just going to move on now. Okay, so again, I'm sorry you won't be able to read this, but where I was getting fixated as I looked through, and it's just an observation, is if you happen to be one of these smaller organisations that's got an RDR that goes 50, 50, 49, 49, 48, 47, 51, then what you're going to find is that you're continually going to be having projects that set up an NSFR reporting capability, because it says here you have to do it, and then disbanded because you're above the 50%, and then 3 months later you're the other side. So there could be some coming and going for firms that are quite close to 50%. In reality, this might not be a problem, because the vast majority of small firms, other than the discussion, the one referred to that's mainly corporate deposits, maybe firms are either very clearly above 50 or below 50. Okay, number 2 of these items is Pillar 2 liquidity add-ons. So this is where firms are required to undertake their own assessment of their liquidity risks. And in theory, at least, the PRA can apply an add-on to the liquidity coverage ratio, requiring you to hold more in the way of liquid assets. The PRA, if you are a simpler regime firm, is proposing that there is no Pillar 2 liquidity add-on. So, one thing that I don't know, and perhaps someone can comment, is that this may sound like a grand gesture, but in practice it may be that for smaller firms there are no Pillar 2 liquidity add-ons anyway. So you're giving away something that they've already got. I've got a small smirk, so maybe.
Chris, we've got another question. Does this RDR distinguish between insured and uninsured deposits?
No. It seems, sorry, the question is, I'll get the hang of it in the end, does the RDR distinguish between insured and uninsured deposits? My view is no, because I did not see a cut-off on personal deposits. There is a cut-off for small business deposits, but not for personal. So I think the answer is no, and I have had that one confirmed. Right, okay. So number 3 of the changes is the ILAAP document template. Those of you who work in small organisations may have spent more of your life than you wanted to preparing an ILAAP. Some acknowledgement. So there is a proposal to simplify the template. The actual proposal, and again, I appreciate it's quite small on the screen, but all these slides will be available afterwards. The new template is on the left, and in terms of what's changing, the new template is going to put a greater emphasis on your stress testing. Obviously, if there's no Pillar 2 add-on, There were some templates that you had to complete for that, so that's gone, as well as the need to focus on things like marketable asset risk, internalisation risk, and some others of these risks that are more likely to apply to a wholesale business than a retail business. And further, it would seem in the PRA's view, a lot of smaller firms are wasting time focusing on the wrong things. So, from the PRA's perspective, there's going to be more guidance going forward, so that will hopefully reduce the amount of time that's wasted, is the logic here. And therefore make this whole process much more cost effective. Interestingly, if you love doing the ILAAP and you're in a small firm, there's nothing to stop you carrying on doing it exactly as you've done it before once these proposals are introduced. And the PRA, as I mentioned, there's always these little sublines saying we retain the right. So whatever you see may apply to you, but there's always a chance that the PRA may knock on your door and say, we retain the right to apply Pillar 2 guidance if we feel that's appropriate. So my next question to throw out is, we see a potentially simpler ILAAP template. For those who are involved in producing ILAAPs, who probably spent time looking at this, do you think it's going to make any difference? Is it going to make the process simpler?
No.
Okay, I've had one offer of no.
Because the stress testing is going to get tougher.
Right. Did somebody unmute me then, or did I unmute myself?
Oh no, you're muted. You should be muted. I'll do that.
Okay. Feedback, sorry. Who knows what's going on? I'm seeing things coming on the slide. Anyway, from the room, the suggestion was to this question, no, it's not going to reduce the complexity because the stress testing itself is going to become more complex and involved. So you gain in one place and you lose in somewhere else, was the thought in the room. Any other observations?
But isn't that the whole idea, is to get firms focusing their resources on their risks? So one of my pet peeves is with all the Basel frameworks, which I've worked under, influenced, and had things to do with bits of them, is that there'd been a move, people confuse what they do for regulatory reporting with managing risk. And the idea with this, and I can see the ingredients here, are to get firms, the small firms, spending their time managing risk, i.e. with the stress testing, rather than just filling out reports with lots of fields that may not apply or be that material.
Okay, excellent suggestion in the room. So the aggregate amount of time we might be spending on all of these things may not change, but the focus will move towards what is more valuable for managing risk, away from what may be dead time or lost time, just filling out templates that no one's looking at and no one's relying on. Okay, good. Thanks.
I have a question on this Pillar 2. So we currently follow the laws of normal firms. So intraday risk, funding concentration. So what will happen to those risks if they are going to simplify ILAAP template or Pillar 2?
You're going to make me look at. I can't see on there correlation. So it has put here all the risks in that middle portion that were discussed and highlighted by the PRA in their amended. So they've got this thing called SS 2415, supervisory statement, and they have proposed a revision to that. And in that proposed revision, have included all of these things in that big box. being ones that you have to cover. I imagine my own feeling would be if there's something not on here that's relevant, that should come up with your discussions with your supervisor, and then you will find that it is, after all, still relevant to you.
Because SS 24/15 is only mostly for pillar 1, but they also there's a pillar 2 guidance for issuing the essentially, and that also talks about like cash flow management risk. It talks about intraday funding concentrations. Those all, I don't know if then where it goes. There's no pillar 2 add-on.
Intraday risk is on there. So some of those I didn't see cash flow risk, but intraday risk is definitely on there. So is captured as something that you should include as part of your ILAAP, even if you're part of the simpler regime. Okay. Okay. Sorry, is that okay, or do we need to?
Because for intraday also there is a separate regulatory template which is required once in 3 years. So there is a detailed template we have to do as regulatory.
Okay, so that's the regulatory return. This is obviously...
That also cover part of ILAAP. You know, in ILAAP pillar 2, also you need to assess how much. If you can't assess, you can't manage intraday, there is a regulatory add-on by the
Okay. Interesting, because so that it's about, or the discussion is about the intraday risk and the ability for the PRA to add or to impose an add-on under Pillar 2. I've just gone through and said if you comply with the simpler regime requirements, then there won't be Pillar 2 add-ons in future. However, intraday risk is something that is included in the template that you need to complete. So the question is, if you haven't got the right answers in that template, what will happen to Pillar 2 add-ons? I imagine it will be caught by some of the small writing that you don't see that basically says, if you don't comply, we can get you anyway. That's how I imagine. So in the end, this is all focused towards all of those institutions that probably are not affected at all by things like intraday risk. There's a saving for them, but if you happen to be, then funnily enough, you'll find that you're probably still doing similar to what you've done in the past. So change number 4 is about liquidity reporting. There are a number of different aspects of liquidity reporting on an ongoing basis. So there's the LCR reporting, there's NSFR reporting, and there's something called additional monitoring metrics. These additional monitoring metrics are on things like contractual maturity ladders, concentration risk of funding by counterparties, concentration risk when we're looking at products, the prices of various lengths of funding, the rollover of funding, and finally something that always confused me until I knew what it was, concentration of counterbalancing capacity. Basically, where you can borrow money to help you out. So we've got all of these, and there's extra information on these returns, but basically we've got these 6 returns, which interestingly, in the document it says there's 5 returns, and I could not get my head around, I know which one the difference is, but as far as I'm aware, there have always been 6 returns, these 6. But CP423 says there's 5 returns. Anyway, all will be clear. So I have put a dotted line around the one I'm not sure about, because CP423 only mentions the other 5. And yet every document that's ever been written on additional monitoring metrics says there's 6. So the status of C66 contractual maturity ladder, I'm not sure. But relating to the other 5, which simpler regime firms will complete at the moment. You didn't stop, you have to stop. Right, I'm carrying on, Ed. I'm expecting Jeremy Beadle to come around the corner in a minute. Those of you who know Jeremy Beadle. Most of you are too young. So there's 5 or 6 returns, and the proposal is for simpler regime firms that 4 of them are stopped. So concentration of funding by counterparty, prices for various lengths of funding, rollover of funding, the counterbalancing capacity, return, all of those going. The only one that definitely remains is concentration of funding by product type. Just to give a bit more colour, because the situation as ever is slightly more complex. So on the left-hand side, these so-called simpler regime firms, there's a small sting in the tail. At the moment, when you complete C68, which is the template to do with concentration by product type, you only have to report on products that make up more than 1% of your balance sheet. Going forward, if these rules are accepted, you need to report on all products, irrespective of whether they're above or below 1%. From the PRA's perspective, they're saying actually this is easier because at the moment you're going through a process to work out whether it's above or below 1%. In future, don't worry, because just report everything. If we look at the middle, there's at the moment, so if we put simpler regime firms to one side, there's another definition of small and simple out there, something called small and non-complex institutions. In most cases, simpler regime is equal to small and non-complex institutions, but in a few cases it might not be. Now, I'm not going to go all into the definition because I don't know that much about it. However, most small and non-complex institutions will be the same as simpler regime firms, but not all. So if you happen to be subject to small and or you're what's deemed to be a small and non-complex institution and you don't comply with the simpler regime rules, then you have to continue reporting all of these. And in fact, at the moment, those small and non-complex institutions have to report these quarterly. In future, they will have to report them monthly. Now, the PRA obviously thinks this is a big issue because there is a 3-year transition period, which seems to me very long. But anyway, so it's a bit like simpler regime firms definitely gain, but if you're small and non-complex and not simpler, actually your requirement is going up. And then any institution that is neither of those is just going to have to carry on reporting on a monthly basis. We're almost there. So we've already discussed how talking about data points may not be as valuable as the PRA has told us. However, it's worth pointing out that this change should reduce the number of data points that are reported by 4,294. Not 4,295 or 4,293, but 4,294. And the EBA, not the PRA, but the EBA for banks in Europe has estimated that this reduction, the change in the ALMM returns that you referred to earlier, sir, is going to reduce your costs by 2 to 3% if you are caught by these changes. So if you're simpler regime. That's what the EBA concluded, and the PRA has said that sounds like a good statistic, so they've just reported the same one. So just a couple of questions on this. Is it simpler to report all product types rather than those comprising greater than 1% of liabilities? Any thoughts? So the PRA tell us it's simpler to report everything. For those who are involved, is that true? Are you spending much time working out whether it's above or below the 1% cutoff? Or is it negligible? Any views online appreciated as well?
The smaller banks don't have so many products, so it's irrelevant talking about 1% if they have only 10 products. So I think, yeah, it becomes irrelevant.
Okay, so suggested in the room, probably less than 2 to 3% saving for smaller banks. So in that case, you've kind of answered my second question, is the estimated 2 to 3% cost saving worth the effort? From your view, certainly, maybe not. Something that worries me a little bit is if you read the detail of the rules, we have the possibility of ad hoc PRA requirements. And I am thinking if your firm is anything other than bulk standard simple, then there's a possibility that the ad hoc requirements kind of make up the gap. So they say, here you are, have lots of saving, and then over here say, but now we want all this extra information on you. I don't know, I'm just saying that's possible. This is the last one, I think, virtually. So, Pillar 3 disclosure. This does, on the surface, appear to be good news. Great. So the idea is Pillar 3 disclosure is an important part of a well-functioning financial system. The problem is for smaller organisations, some people look at the quantitative disclosure, but nobody looks at the qualitative disclosure, apparently. So therefore, why don't we get rid of some of it? That, to me, makes a lot of sense. So here's the actual proposal. So the simpler regimes in this, the simpler regime firms in this case are split into two categories: listed and not listed, or not listed and listed. But if you're not listed, the proposal is no Pillar 3. Do away with it completely. If you're listed, then it's not completely being eliminated. However, the requirements are being significantly reduced. The qualitative requirements are going. The quantitative requirements, some of them are staying. For those of you who work with this stuff, the key returns that are staying are the KM1 and the OV1. In theory, this change, eliminating the qualitative, etc., reduces the number of templates that have to be completed for listed simpler regime firms from 88 to 7. So it sounds like a significant reduction.
Chris, there's a comment online. This does seem out of sync with the current banking crisis in the US, where small bank regulation is about to become final.
Excellent point. So for those of you who are online, and I did hear this mentioned earlier in my discussions, the problems in the US, the recent bank failures, are going to kick off a wave of an increase in small bank regulation, and we're sat here talking, or stood here in my case, talking about a reduction. I don't know whether we're talking timing difference or not, but you know. So all we can talk about is the rules in front of us at the moment and the proposals. So maybe you...
How does this align with the FRC requirements that you're listed? Financial Reporting Council.
Okay.
Listed companies obviously have got certain reporting requirements as well, so do we know what the alignment is between the two?
A good point. So the middle category of this slide, I have to be honest and say I haven't gone through this, but I'll throw the question out there. Listed companies need to make financial reporting disclosures, and the question or the comment is, to what extent does this proposal align with any financial reporting requirements? My presumption would be that if the PRA says there's no need to report Pillar 3 or only the quantitative side of Pillar 3, then my presumption would be that that is in full alignment with the requirements of the financial reporting.
Yeah, but you have to report to principal risks and uncertainties in round reports under the FRC requirements. And I'm just trying to see, because that's very qualitative driven compared to what's been suggested by the PRA, just to stick to the quantitative. So that's why I've asked the question.
No, excellent question. One thing that we will look at, just when we finish in a moment, we'll see, because the 5 questions the PRA has allowed the industry to comment on, we'll see if that's captured. Because certainly one of them is a bit of a catch-all, so there might be an opportunity to throw in that question to find out. Finally, I mentioned there's a small number of firms that are classified as small and non-complex, that don't meet the simpler regime requirements. And in that case, there seems to be a change in the templates these firms need to report. Because the bit that struck me as I read through is there's a 3-year transition period to adjust for a reduction in the number of templates from 12 to 7. So my logic says the only way that you can have a 3-year transition period is if actually the 7 is different to the 12. Because otherwise it would just be walking, cross off 5, go home, job done. 3 years to do that? So the implication is that it's a different 7 templates. Okay, I've said some of the top part. My challenge around all of this would be, when you significantly, and I heard the earlier view when we were talking about ILAAP, that if you take away the reporting requirement, it enables executives to spend more time on managing risks. And that's the PRA's view. There is a contrary view that says, if you stop reporting all this stuff, then what's the possibility that actually nobody looks at it? Because at the moment, we have a sign-off process with someone senior in finance, possibly someone else senior, or a group of people senior in the organisation, signing off all these returns. So they're looking at it and they're challenging it and they're asking questions. Get rid of all the returns, they're not doing that. So this only works if those executives are really spending their time on risk management. Okay, I've asked it as a question, but actually it's more of a comment. But obviously overall, and I hear some of the negative views that have come in actually from the gentleman who's now gone, but the point is, overall, as I read this package, it looked to me that for a smaller firm that satisfies the requirements, there is a genuine reduction in what they may have to do going forward, was my conclusion. I said we just come to the 5 questions. Okay, I'm not going to run through them all now, but the comment earlier about how does this align with the financial reporting requirements, I wonder if it's captured or could be captured in the response to these 5 questions. So as you go through all of the Proposals, the PRA has asked 5 specific questions and the PRA wants feedback on those questions by the 30th of May. So if your organisation is in a position to feedback, that's your cut-off date. The one I found interesting was number 5, because it said, are there any factors or stakeholders the PRA has not identified or considered sufficiently in respect to the proposed exclusion of non-listed simpler regime firms from Pillar 3 requirements? So it sounds to me that there's something out there that they're a little bit worried about, but they're not quite sure what it is, so they're asking the industry, what have we missed? Okay, it's consultation. That's part of consultation. Okay, we're on to any residual Q&A. I know Peter and Marita, we were going to sit there. We don't have to go through that. Hopefully, I've achieved the objective. If you didn't know much about this, you know a bit more about the proposals that are coming forward. And you know when the consultation period is, and you know there's 5 questions that you may choose to respond to. You will have noted that there is a degree of cynicism around the room. A degree, some people saying it's maybe not as much of a saving as it appears. However, I would say that's probably natural. But, you know, that's the position. Any other questions that you would like to ask? And if you do, you're asking them to Peter, to Margarita, and to me, and in fact to everybody else in the room. Has anybody got any other questions?
I have a question.
Yeah.
So in RDR, sometimes we also take deposits through platforms, although we believe it's a share deposit. But would it be different than what we do directly or through face-to-face?
So is this like when Saga have a bond offer or something like that, or maybe it's not? That's that, because that, I mean, to me, the issue is whose balance sheet is it on?
It would be still low.
If it's on your balance sheet and it's retail, then my view, it counts as retail funding as part of the RDR.
So no different.
That would be my view. Any other thoughts from anybody around the room?
It depends on how you structure your product, the product you're selling.
Yeah.
That also will.
But that would be like just going to the platform.
For LCR purposes, the parties have been inputs and they should be treated as they don't see any they are applying for part of the.
Okay, so I think our general conclusion is that if it's retail on your balance sheet, that's what it is, and that's how it will count for RDR. Yes.
Right, I'm kind of just going to say, it's basically there's a calculation in the suggested which comes off the return, so that definition in the return.
Right. Okay.
So, can I make one other?
Yeah, just let me answer this one, and then yes, to the guys online. So, in terms of the question that's just been asked around whether certain types of deposit count as retail or not, the answer is there's an embedded calculation for RDR, which, although I haven't seen, is picking up information that's already prepared, and actually just by applying that would answer the question totally, because it will be certain lines that are currently produced. Yes?
It's treated differently.
It depends how it's treated in the other returns, based off of the dividend return. Sorry, the more general point I'm just going to make is, please, there are 5 questions we specifically want feedback on, but we want feedback on the whole thing.
Okay, excellent.
So it's not like you're not restricted to only answering those questions.
Right.
And we're very open to having feedback on the whole thing. So whatever it is, we're happy to receive it as feedback.
Okay, excellent. So just that point in terms of if there's anything else about anything you've heard about, the PRA are looking for feedback on all of it, and not just on the 5 questions, although you may be drawn to the 5 questions. Jeff?
There's a couple of questions that have come through online. And if anybody's got a question I might ask us to use online, then we can hear what's on.
Okay, so there's a question here from MK. What about deposit brokers / deposit aggregators? Well, there appear to be two answers to that. One, there is an underlying calculation, and when that's applied, that will tell you. But the other answer is my simple version is it a retail deposit on your balance sheet? And if it is, my starting position would be to expect it to be counted. However, subject to whatever the nitty-gritty calculation is. And then another question, how would they be adequately captured in ALMM? In terms of the conversation around product type, I guess that is. Obviously, one answer is if there's anything that's not clear when these rules are finally implemented, then it just becomes a discussion with your local supervisor just to check that you're complying with the way they expect you to comply. Any other thoughts on that?
The deposit aggregators are retail deposits. I think when NSFR was implemented, banks like us, we have very difficult to maintain 100% NSFR. So that time, most of the banks use this retail deposit aggregators. And I think we had a discussion with external consultant, and it was agreed with PRA and categorization. Okay, so
around deposit brokers and deposit aggregators, one of the colleagues in the room has had specific experience on this subject. Are we all part of the forum, the BTRM forum here? Ed? Neil? How many? Okay, right, so not everybody. Well, all I can suggest, so MK online, if we could have just a brief chat afterwards, and then I can basically put the two of you in contact with each other, because there may be things that you can just discuss at a high level that might be appropriate to both of you. Okay?
If there's any members of the BTRM faculty who want to speak, I'll hand you this microphone.
I was thinking, yes, I can be heard, I think. I was just thinking if I was on the board of an institution that qualified for this regime, I might need a bit of persuading as to why we should opt for it. If the reduction in the burden of compliance and calculation and reporting is not enormous, why would you not remain, in a sense, best in class? Even if by the time this comes to be implemented, the current sort of febrile environment has calmed down, I think, clearly, it will come, similar events will come back in the future. And it does seem to me that as I said, I would probably need a bit of persuading to opt for it. And it might be interesting to see just how many institutions take that particular line.
Yeah, I mean, my view on that coming through the proposals, there are a few occasions that say you don't have to do this if you don't want to. So clearly there is an expectation that not all firms who are capable of switching to this simpler regime framework will actually opt for that.
But I would argue that in a way, more is not necessarily best in class. Because so I work in risk and regulatory advisory. I do see a lot of banks, and one of the common themes is too much information sometimes for proper decision making. So I think sometimes it's for the board to decide actually maybe scaling down some of the data points, not looking at certain things, but focusing on things that are relevant to our business and allocating the time in a good manner to that topic is the best practice of doing things.
Yeah, and to pick up on that, and going back to my previous point, is that the ability to actually do stress testing, decide on what's the best stress test,
really go through that exercise is better, I would say, is best in class versus reporting a whole bunch of numbers that may not be that material. You know, so, and on that whole U.S. question, you know, you have to look at what's going on in what was going on in the U.S. They didn't even have a chief risk officer, you know, for like months and months, and they didn't even report the LCR. So I don't think it's going to something simpler here, when the U.S. is going to something for smaller firms, perhaps that will bite more for smaller firms. The difference is still going to be quite. The UK simpler regime is still going to be above what SVP was. So I think that's just a lot of noise and maybe not understanding what the proposals are about.
Okay, there's quite a lot for those guys online that's just come up. So the first part was around just churning out more information in itself is not necessarily a good thing and doesn't necessarily make you best in class. And the second point was around the regulatory standards that have applied to the bank that's failed in the US may be much lower than the regulatory standards that will be applied to simpler regime firms after all of this has been implemented. Have I got that right? Yeah, I've got vague nods, so we'll stick with that. Any other points? All right, guys, look, thank you very much for staying the course. I hope that you've found some interesting points and you've picked up on some things. It's great that we've got representatives from across the industry, including the PRA, and if my slides are wrong at the beginning, then they will get changed and it will be the revised one that gets posted. So I've got a chat yet to come that I'm looking forward to. Anyway, thanks ever so much for your time and hopefully see you at another one of these events soon.